Welcome to another deep dive. Today we're taking a really close look at some specific source material. It's a detailed stock report for ABVC Biopharma Inc., ticker ABVC. Our mission really is to unpack what this report tells us, about the company's financial health, its valuation, and its current market momentum. You'll get a shortcut to understanding what these complex reports reveal. And honestly, there are some surprising, maybe even conflicting facts along the way.
Yeah, it's quite an interesting case study. It really shows how different metrics can, well, tell very different stories about the same company. We're here to help you navigate the nuances of this biopharmaceutical company's current standing, helping you see the full picture.
Okay, great. So let's unpack ABVC Biopharma first. What exactly are they? What do they do?
Right. So according to our source, ADVC, it's a clinical stage biopharma company. They've got an active pipeline, looks like 6 drug candidates, and 1 medical device, specifically ABV 1701 or Vitargus. Their niche seems to be developing botanically based solutions. They're aiming for, high efficacy but low toxicity, trying to improve health outcomes that way.
Got it. Botanically based. And what's a sort of snapshot of their market position right now based on the report?
Okay, the report shows their current stock price at $3.10. Market cap is $52.6 million. Average daily volume is about 1.2 million shares. That's pretty active. And looking back over the year, their 52-week price range has been between 40 cents and, well, the current $3.10. So quite a run up there.
Yeah, big range. Now, this report uses a framework I found really interesting, DVM. Stands for durability, valuation, and momentum. Each gives us a different lens on the company, right? Could you maybe break down what each score is trying to tell us?
Absolutely. Yeah. So first up is the durability score. It's on a scale of 0 to 100, and they say 55 plus is good. This score tries to find companies with, good, consistent financial performance. Think stable revenues, strong cash flows, low debt over time. It's looking for stocks that have, stood the test of time.
Okay, solid foundations. Makes sense. What about valuation?
Right, the valuation score. Also 0 to 100, and here 50 or higher is considered good. This one helps you find stocks that seem competitively priced. The idea is their strengths might not be fully baked into the share price yet, so potential bargains. A low score, on the other hand, means the stock looks expensive compared to its underlying value metrics.
Expensive, okay. And the last one, momentum.
And finally, momentum. Again, 0 to 100, 60 plus is good here. This is more of a short-term thing. It looks at buyer demand, technical indicators, basically asking, is the stock price going up right now? Are volumes and sentiment picking up? Is there bullishness?
Gotcha. Durability for the long haul, valuation for the price tag, momentum for the current buzz.
So let's start with durability, because this is where, for me, it got really interesting right away. ABVC's durability score is not eligible, 0 out of 100. What does not eligible actually mean here? It sounds not good.
Yeah, it's pretty striking. Not eligible basically means the report couldn't even assign a score. They couldn't properly compare it to its peers on this metric. It suggests there's just a lack of that consistent long-term performance data they need for this calculation. The report is explicit. ABVC Biopharma Inc.'s durability score is not available and cannot compare with its peers. And just for context, top peers like J&J score around 33, Novartis is up at 61, so 0. It means there's really no history of stable financial performance to measure.
Wow. Okay. So what does that imply about the company's foundational financial health? Is it just leak? Well, if you connect it to the bigger picture and look at the underlying financials in the report, yeah, there are some significant challenges. These are often, red flags. They have a negative PE ratio, trailing 12 months of negative 29.1. That just means they're losing money. Their return on equity annual is negative 352.7%.
That's low.
It really indicates shareholder equity is being burned through. Net profit annual, negative $4.9 million. And things like total assets, total shareholders' funds, they're falling faster than historical averages.
Oof. Okay, those are some tough numbers.
They are. Now, you do see high revenue growth. Annual year-over-year is 234.3%, which is high in the industry.
Yeah, right.
But their actual total revenue annually is only $500,000. That's below the industry median. And while cash from operating activity growth is up compared to history, their net profit per quarter is actually falling faster than average. So it raises that big question, right? Can this high percentage growth on a small base actually translate into sustained profit and positive cash flow? The not eligible durability score suggests not yet, or at least not consistently.
Right, so the foundation looks shaky, maybe even non-existent by that metric. Let's pivot then to valuation. How is the market pricing this? ABVC has a score of just 4 out of 100, and the report calls it expensive valuation. How? how can a company with those financials we just discussed be considered expensive? That seems counterintuitive.
It does, and that's a really important point for you, the listener, to think about. Remember, a high valuation score means it might be a bargain. Its strengths aren't priced in. A low score, like ABVC's 4.2, means the opposite. It's judged as expensive. It implies that whatever the market perceives as potential strengths or maybe future hope, it's already more than reflected in the price.
So the market price is way ahead of the current financial reality.
That's what this score suggests, yes.
Yeah.
And 4.2 is the lowest score among its peers in the report. Lilly's at 26.7, J&J is 39.2. So relative to them and its own numbers, it looks way overvalued by this measure.
The report mentions price-to-book value of 9.7, price-to-sales TTM of 103.5. Can you translate those? What do they tell us about this expensive label?
Sure. A price-to-sales ratio of 103.5, that's extremely high. Compare it to Lilly at 14.3 or J&J at 4.2. It means investors are paying like $103 for every single dollar of sales the company currently generates. It suggests huge expectations for future sales growth.
Or maybe just speculation.
Could be. And the price-to-book of 9.7 means the market values the company at almost 10 times its net asset value, what it owns minus what it owes. Again, for a company with these financial challenges, that's a massive premium over its book value. It suggests confidence is driven by something other than current assets or sales.
Okay, so durability is basically zero, valuation screams expensive. But here comes the twist, right? The momentum score. ABVC scores 84 out of 100 here, described as technically bullish. What's going on? How can it be so high when the other scores are so low?
Exactly. It's a fascinating, stark contrast. While durability is missing and valuation is poor, the momentum score is incredibly strong. 84.4 is actually the highest score among its peers listed, where the others range from about 31 up to maybe 66. A high momentum score like this signals strong current buyer demand. The technical indicators are flashing green, basically. The market right now is pushing the price up.
Okay, so the trend is strongly upward. The report says it's trading above all 8 simple moving averages and all 8 exponential moving averages. What's the significance of that for listeners?
Right. Those moving averages, SMAs and EMAs, they're key technical tools. They smooth out price action to show trends over different periods, short-term, long-term. When a stock price is above all of them, from the 5-day to the 200-day, it's generally seen as a very strong bullish signal. It shows consistent upward price movement across the board. Buyers are in control across multiple time frames.
But it also mentions the RSI and MFI indicators are high, suggesting it's overbought and a pullback might occur. So the momentum is strong, but maybe too strong. Could it reverse?
That's the caution flag within the momentum story. RSI, the Relative Strength Index, and MFI, Money Flow Index, are oscillators. When they get above 70, like ABVC's 75.8 and 79.4, it suggests the price has risen very quickly, maybe too quickly, and it might be due for a correction, a temporary drop, or a pullback, like a runner needing to catch their breath.
Okay.
The report also notes a 3-month beta of 1.07. That means it tends to be slightly more volatile than the overall market anyway, so swings could be sharper.
So strong trend, but maybe overheated and volatile. It's a complex picture. Beyond just the DVM scores, there's also this trendline checklist, kind of like a report card, right? It says 50% of criteria passed. Let's break that down.
Yeah, this checklist gives a more point-by-point view and really reinforces the contrast we've seen. Under financials, it only meets 1 out of 7 criteria. It does have positive net cash flow, which is something. But big buts here, it doesn't show consistent profit or sales growth over the last 8 quarters. No high durability score, obviously. Doesn't have low debt.
Yep.
Doesn't have strong ROE. So mostly fails on financials.
Okay, mostly fails there. What about value and momentum?
Value momentum, it meets 4 out of 8. The momentum score is bullish, yes. It is trading above all those moving averages. And no recent bearish candlestick patterns, apparently. However, it's not considered in the buy zone based on historical PE or PB ratios. The valuation score isn't good, and it's not showing certain types of positive technical breakouts. So a mixed bag there, mostly leaning on that momentum score.
All right. Ownership, how does that look?
Ownership looks better, meets 3 out of 4. The report says mutual funds and institutions were buying in the past quarter. Promoters' ownership is stable. And MF institutional holdings are rising over the past year. The key miss, though, and it's an important one, insiders have apparently sold stock in the past 3 months.
Insiders selling while institutions are buying. Interesting. And peer comparison.
Tier comparison, 2 out of 3 met. Its sales growth percentage and profit growth percentage are better than the industry median. Again, likely from that low base. But, crucially, it's not giving better long-term returns than the industry average.
Got it. So the checklist paints a similar picture. Strong momentum signals, some positive growth percentages, but weak core financials, expensive valuation, and mixed ownership signals with those insider sales. And you mentioned ownership. What about the overall shareholding summary? Anything stand out there?
Yes, quite significantly. The report highlights that retail investors, labeled Others Data, make up the overwhelming majority of shareholders. We're talking 97.9% as of May 2025.
Wow, almost 98% retail.
Exactly. Mutual funds actually decreased their holdings slightly, 2.08% down to 2.07%. Institutional investors held steady at just 1.69%. This really raises a key question for you. What does it mean when a stock's ownership is so heavily concentrated in retail hands, especially when its momentum is high, but fundamentals are weak? It often suggests the price movement is driven more by individual investor sentiment, maybe online buzz, rather than, deep institutional analysis.
That makes sense. So, putting it all together, what does this mean for you, the listener? We've dived into ABVC Biopharma, and it's revealed this company with, well, these really stark contrasts. You've got this incredibly strong short-term market momentum side by side with a not eligible for long-term durability and an expensive valuation tag.
Yeah, if we connect this to the bigger picture, it really underscores that a stock story isn't just one number, is it? Or even one type of analysis. The report clearly paints two pictures. One is this very bullish short-term technical surge. The other shows significant long-term financial hurdles, negative profits, questions about sustainability, and these very high valuation multiples. It looks a lot like a speculative situation.
So, this deep dive leaves us with a perhaps provocative thought for you to consider. When you encounter a company like this showing such high, almost euphoric short-term momentum, but it's paired with really significant long-term financial and valuation red flags,
Yeah.
what factors do you prioritize? How do you personally weigh the evidence when you're trying to be well-informed? What kind of balance do you seek between that allure of potential quick gains and, well, the perhaps less exciting bedrock of fundamental stability? Something to think about.